Hey everyone, welcome to another episode of Mere Finance. Today we're going to talk about the bond market and how it's inherently important to the development and the performance of the commercial real estate sector. So what we see is that it signals deep trouble for commercial real estate, and we're going to explain how from a financial and mathematical point of view. But before that, don't forget to subscribe. And let's start with the episode. So, responsible investment in commercial real estate requires a thorough understanding of the bond market, because commercial real estate cap rates, so yields, basically what you get from your investment, simply compete with other financial products that provide income, and investors are always shifting to investing in whatever pays them the most risk-adjusted income. By this means, as your risk goes up, your income should go up. And if you are having another investment that has higher income with the same risk, then you are going to move. Just think about it. Before that, just think about how cap rates work. So cap rates are the net operating income of an investment. So say your rent, how much you're getting money from rent, minus all the expenses, and then you divide that by the asset value of the property. So that's just your cap rate, and this cap rate should be compared to other yields of different investments. But remember how people shift from one investment to another. Just remember at the beginning of this year, as rates were going up, how people move from your money from savings account into certificates of deposit that were paying 4% instead of your mere 0.5 or 1%, even that's a little high for savings rates. Or also you move into high yield savings accounts, which is paying above 4%. And even more, some people even went into treasuries that are paying 5%. So it happens really quick. When you compete for yield, people move, people shift. So it's a no-brainer. So we are in a climate where bond rates are climbing substantially as government continues to turn to issuing bonds, and this is causing disruption in the rate. So the perception is that commercial real estate owners or investors are convinced that the increase in rates will not last long, but signs simply point otherwise. How do we analyze it? Look at this. This is the effective federal fund rate, which is basically the benchmark or the starting point of borrowing costs. You can see 18 months ago, it was 0.08, 15 months ago at 0.33, 3 months ago, it's already at 5.08. It's a tremendous increase in borrowing costs, and we're going to see bond rates higher for longer because inflation is still creeping there, and still we haven't seen any signal that rates will go down. So there's a recency bias. Recency bias is basically placing emphasis on the last trends. So for the last 5 to 10 years, investors have seen borrowing costs close to 1 or 2%, extremely low. And cap rates were usually at 4% to 5%. And they were justified because of their borrowing costs being so low. So you have borrowing costs of 2% and your cap rates at 4% or 5%. That difference, which we call a spread, we'll explain it a little bit later, it was justified. But then if you are buying in a market right now at 4 or 5%, you are assuming that in the future, your borrowing costs are going to go back to 2%, and we don't simply see that going on. So there is different facts. The facts are that we are not here to make predictions, but we can see that exit cap rates are based on the fact that commercial real estate is a financial tool that provides yields, yes? And based on the fact rational investors know commercial real estate comes with inherent risk. And the risk should be justified by your spread. Your cap rate should be higher than your borrowing rate. Your borrowing rate is how much you go to the bank and you take out, and then your cap rate is how much you get from that investment. The bigger the spread usually signifies higher risk, But at some point, even though if you're in the best properties out there and your cap rate still competing with your borrowing rate, then probably the whole real estate sector is not a good investment. So let's make an example. I think we say that in an environment that would cost 7% to borrow, which is what we see now, like mortgage rates are around 7%, a 50 to 250 basis point spread is required in order to purchase of a stabilized property to make financially sense, right? Like it makes sense to have that kind of spread. But the issue is that means that Class B properties, Class B we usually consider properties that are in secondary markets or top or tier 2 markets or properties, or even that are not as popular. We can explain those in another video, but Class B says like properties that are not the best, but they're pretty good out there. So usually require a 9% cap rate. And then a Class A properties in prime markets, say like commercial real estate in New York City for office, for example, they should have a 7.5%. Now, this is only 100%, like 100 bips more than investment grade bonds. So basically, you are getting only 1% more for investing in commercial real estate instead of just holding an investment grade bond. So, yes, we don't see these cap rates yet, but we are predicting that this is what the market is going to ask to justify investment. And if your cap rates go up, that actually means your asset value has to go down, because we're going to show rent is not going up. So rent is the way you get your money. If your net operating income isn't going up, in order to your cap rates go up, you need to have your asset value, your property prices go down. So as we say, but there is something even worse. So as cap rates go up, then your asset value goes down. And if you have leverage at 80%, right? So if you ask for money to the bank and you have a loan, your equity actually evaporates. So let's see how this works. For example, a property maybe 5 years ago or 3 years ago, when borrowing costs were 2 or 3%, it was generating $600,000 in net operating income a year. And then your property, your asset value was at 14 million. So I was giving you a cap rate of 4.3%. Now T-bills right now are at 5%. So there's a no-brainer. You wouldn't basically go for this deal, even though your cash on cash return might be higher. But with these rates, if you compare 4.3%, which has a higher risk than a T-bill, well, you should just go to your T-bill because it has a better risk reward adjusted income. So let's say we assume that no price power to increase rent. There is no price power. You see real estate occupancy rates going down. The work from home is still there for different companies. I don't think we're going to see the pre-pandemic levels of working from the office. So there is no price power to increase rent. That means your cash flows will remain the same. So, but let's assume rent goes up by 5% and your cap rate is at 7.5%. This means your asset value will be now 8.4 million from 14 million. This is heavy because then you actually, your equity, so the 20% or 30% down payment that you put, it's actually evaporating completely. You don't have any equity in your property because as your asset value just goes down, everything that you have put, your equity also goes down. And this math makes sense. Like we're not justifying. And we start to see a little bit like CMBS, delinquency rate tops 4% in July 2023. So office and lodging delinquencies increase again. So at this time, I think the new reality is here. The new reality is higher for longer in borrowing cost. We're going to see higher cap rates as well. But also we're going to see a lot of trouble in the commercial real estate that will affect the whole market. So for now, we are not predicting anything, but I think the math makes sense to really avoid commercial real estate as your investment. So let us know what you think and please leave a comment or share with other ones to have this conversation open, because here we are not predicting anything, we are just basing on quantitative and trends that we see. So give us a like, a comment, let us know what you think, and we'll see you in the next episode of Mere Finance. Thank you.